Okay, hi everybody, and thank you so much for coming. This is part 2 in our 3-part series of how to buy a business. We're covering all the essential information that you need if you're interested in getting your own acquisition. The first one was, what was the first one now? Valuation.
Business valuation.
Yeah, business valuation. Now we're going to dive into financing. We have switched systems, so if you were in our last meeting, I apologize for the technical sort of mishaps. Now you are able to join the chat. You're able to unmute and put your video on. Sorry. So please, we want this to be a very interactive experience. Please feel free to raise your hand, send a note, send a question all throughout the presentation. We love to have a conversation and have everybody involved. So if something comes up that we're touching on, please feel free to ask, because there's likely more than one person that has the same question. So yes, we definitely encourage you to get involved. Then if you haven't already registered for our final one, due diligence, that will be next Thursday at the same time. So please make sure that you register for that. I will quickly introduce our 2 speakers again today. So we have Keith MacKenzie. He is the founder and managing partner of Chinook Business Advisory, local business brokerage in Victoria, BC. We are a full-service business brokerage, and we have offices all over the island, and we assist clients across Western Canada. We are primarily focused on the seller, but we do work as intermediary, and we help the buyers and the sellers achieve the same goals that they're looking for. With us, we have Liz McCrae. She's the co-founder of Village Wealth, and they are all things buyer. They are a Canadian-based acquisition management platform. They have programming and support in place to help buyers with the entire process, from looking for acquisitions to financing to due diligence and closing. So her expertise is very valuable in these presentations, and we look very forward to seeing her answers on this one in financing. So, did I talk too fast? Really talk fast.
That was great, Brianne. Thank you very much for the introduction. Yeah, so this one is really, I think, overall is going to really sort of lean into Liz's strengths more than ours. We see a lot of end results of financing. We do help buyers as they get farther into a transaction. But Liz's team sort of works with them right from the very thought of buying a business right through to getting the financing in place and closing the deal. So very excited to have Liz on board today, and with all of her expertise. So this is I'm excited to get going here.
Thanks, Keith. Really happy to be here and see more folks in the space that are starting to explore acquisitions.
Yeah, we got, looks like a bunch of people on board today. One of the things that we do want to encourage everybody is to use the chat. If you've got something you want to talk about, let us know in the chat. I think we should be able to let you come in and speak to the group. So I will, Brianne, I'm going to make you the host, so you'll be able to sort of help with that.
Okay, I did see one question come in. Somebody asked if there was a recording for the first webinar, and there is. I'm just gonna, once these guys are talking, I'll go find the link and I'll drop it in the chat for anybody that would like to review that presentation.
Nicely done. And oh, you're starting here.
Can everybody see my screen? Okay, great.
Looking good.
So for most of the businesses that we work with, and for most of the buyers that we work with, they tend to be Main Street businesses, you know, sub $5 million. And so there's so I think, Brand, you're showing everything here.
Yeah, I realized I just clicked the wrong button. I'm so sorry.
Yeah. There we go. Yeah. So what we've found over the years, what we've learned is that for buyers in the Main Street space, they're looking for, basically, in order to purchase a business, 3 things have to work for them. So they have to find a business, first of all, I guess maybe 4 things that they like and that they can see themselves wanting to do for a number of years. And then when it gets into the financial side of things, the business has to do 3 significant things. One is provide them a living wage, because typically a buyer in this space is giving up something. Most of the folks in our group here are not going to be, I don't believe anyway, looking for businesses that are fully investable, where they can put some money in, have a general manager in place, and then, you know, go to the Baja and enjoy their dividends. I think most of the folks here are going to be looking to buy an operating business and be a part of that business. The second thing that a business owner needs is I guess I will say that for the most part, people don't purchase businesses with all their own cash. OPM is the acronym, other people's money. And so that business that you're purchasing has to be able to debt service itself. That means they have to pay the bank back after tax money, and pay the interest on the debt. And typically a business buyer will invest some of their own funds into the purchase price of the business. So they're going to want to have a return on that money. So we call that a return on invested capital, or ROIC. Liz, do you want to add anything to that particular group of comments?
Yeah, we typically see the same kind of types of buyers, those that are going to be actively involved in the business that they acquire. And yeah, being able to make the loan payments, the principal interest payments on the loan is one of the core elements that we look at, and we train our members to look at immediately. Is if you're going to be pursuing financing, those numbers need to make sense before you spend too much time looking further into the business, because if it's not bankable, then it's not a good fit on that criteria.
Yeah, and it sort of leads back into what we talked about last week, is the business valuation. So in order for all of this stuff to work, the business has to be priced at a point where all of these three things work. So if you're just able to purchase a business and it debt services and doesn't provide you a living wage, unless you have another source of income, it's probably not going to be a good fit for you. Or if it provides you a living wage and it debt services, but there's no return on your capital, then maybe again not the right valuation for you, or maybe it's overpriced, or maybe it just doesn't fit for those reasons.
And we see people also, when we talk about the return on investment capital, is people are, when they're deciding, to go down this path or not, often I think Keith, you had mentioned it, they may be leaving traditional employment, and they're, comparing and contrasting about, how they're growing their personal wealth and also spending their time. And if you're making a decision between leaving a career that paid you a predictable salary, and maybe you used any discretionary income for, maybe you had rental properties and you were looking at the investment return from those rental properties. When you get into acquisitions, it's kind of like there's your career and your personal income needs, and then there's the investment return that owning this business will give to you. So a lot of times people are comparing and contrasting, like, okay, if I stay in my current career trajectory, this is what lies ahead, versus if I go in and start doing business acquisitions, this could be my path, and they're taking those investment return formula into consideration as well. And so we see a lot of people doing that math and doing those equations as they're exploring their different pathways.
Yeah, and I think the big thing around that is the returns are typically pretty fantastic on most small business acquisitions, like much, much greater than you get in the stock market. But the reality is that everything comes with risk. So the trade-off, as in everything, the higher the risk, the bigger the return. And I would say that in the small business acquisition space, that is exactly what the game that you're playing. You're trading huge rewards, and you're for a little bit more risk, but you're also betting on yourself, which is a great opportunity.
Month over month, I get a Zapier bill, and I categorize it some way. The AI knows exactly how I categorize it in the past, and it will automatically tell you the same category that you did based on your historical transactions, time and time again. We're getting to 95, 96.
Everyone can put themselves.
Sorry, where's that coming from?
There's a few people that aren't on mute.
Oh, okay. Brianna, I think as the host now, you can mute everybody.
Okay, I just have to see. I've done something to my screen, so I was waiting for Liz to take over.
Oh, sorry.
It's okay. I'm just gonna stop sharing.
You can make me co-host too.
I think everybody can share, Brian, or Liz.
Okay, gotcha.
I'm just gonna stop my sharing so that you can jump in. And then I will take over that administrative. I just had it full screen and I didn't want to close the presentation without you being ready. Okay.
Thanks, Brianne. Yeah, so Oh, go ahead, Keith.
Oh, I was just going to say, if anybody wants to weigh in or chime in on anything, just put a comment in the chat, and we'll unmute you so that you can ask a question or join the conversation.
So we thought we would actually jump in and show you Village Wealth software where we've built it so people like yourselves can jump in and start to run the numbers and run scenarios on deals that you're looking at and how you're formulating your offer on a business. So I'll just share my screen and jump into what it looks like on our platform for managing your deals. You need that.
And Liz, is your software, is it available to like sort of paying members of your community, or can people access this in other fashions?
Yeah, so if you're not a member of our community, you can join our marketplace. So we have a marketplace built in. So it looks like this. So we've got deals of all shapes and sizes. EBITDA typically tends to range from about 150,000 up to as high as a couple of million. So if you're looking for something kind of lower middle market, small business space, we've got lots of deals in there. So that is free to access, is our marketplace. But our software is reserved for members to manage their deals. So this is just deals that I might have found from anywhere. So whether they came from the marketplace, this is where folks are managing their deals in our system, and they can add a deal. So if you find it from Biz Buy Sell, or you find it from Deal Builder, which is the Chinook platform, you can bring it in here and you can add it to the dashboard and keep track of your activity. Once people are looking at a ton of deals, it does get kind of confusing to manage. Well, who said what and where was it? What did I say about it? So we built this management software. And so this is your dashboard, the deal overview. So it asks you a series of inputs. So this business is 1.499 purchase price. The way that the numbers are going in, 2.69 multiple. We put in the anticipated salary. And what we're really looking for is the debt service coverage ratio. So any lender is going to want to see that the debt service coverage ratio, the ratio of how much cash flow there is to cover the loan payments, is over 1.25. So this business is showing a 2, which is great. We've got you have excellent prospects for getting financing on this deal. But where we really like to play, sorry, go ahead, Keith.
Oh, sorry. I was wondering if maybe you could just talk a little bit about how debt service coverage ratio is calculated. What is that? Is that after tax dollars? How does that work?
Yeah, good question. So really what the lender wants to see is they want to see that the business has enough profit to pay the debt servicing, so the interest and principal payment at least a 1.25 ratio. So they want to see 1.25 ability of cash flow to be able to service that loan on an annual basis.
So if you have $100,000 in debt plus interest, the bank wants to see $125,000 of free cash.
Exactly, at a minimum. Yeah, at a minimum, after you've paid yourself too. And that's where calculation, that's where, like last week we talked a lot about EBITDA and SDE and vice versa. At the end of the day, the bank wants to know, okay, you've paid yourself. After you've paid yourself and all of your expenses and everything are paid, what's sitting left over, and for paying taxes as well. We want to make sure that we're covered and that the payments made to the lender are not at risk. And there's a little bit of buffer there in case, the business doesn't have a great year, but there's still a bit of buffer to make the loan payments, because the bank always wants to get paid first.
Yes, exactly that. There's a couple of quick questions as we're going along here, and I'll just try and spit those out. So what is the typical amortization period of these business loans, e.g. loan of $1 million or 5 million? And the size of the loan, in our experience, doesn't really impact the amortization period. It's mostly the lender themselves. Typically, I would say in a business acquisition loan, you're looking at probably 7 years for the most part, a few banks up to 10 years now. Liz, have you seen anything different? Excluding real estate, of course.
Yeah, we haven't seen 10 yet. Maybe BDC. Have you seen 10 from BDC?
No, we've seen 10. I want to say RBC, but it was one of the chartered.
Okay. We
Yeah.
like, I think we'll get there someday. It's certainly not the norm to get 10 right now. We've seen 9 pop up recently too, but yeah, 7-year for the amortization period is most common. We do our modeling off 5 years just to make sure that there's more certainty that we're running the numbers correctly in case.
Right. Yeah. And then we'll talk about some of the different lenders and some of the different sort of approaches that they take a little bit farther along in the conversation. And I think somebody had asked earlier about what about proprietary deals? I think they were referencing the software itself. So if somebody brings a proprietary deal and is a client of Village Wealth, they get the chance to use the software, correct?
Yeah, any deal you find from any brokerage, any source. This is consider this like deal management, like your headquarters for how you're going to manage your search. And any deal you look at can get popped in here, and you can run the numbers on it. And you can manage your documents. So if you get the NDA, if you get the SIM, if you've got the financials, you can all store it per deal. And then you can invite, like if you're working in partners, you can invite your partners in to be in the same space so that you're not constantly, like it gets really confusing when you're just constantly sending documents back and forth to everyone. Like for people who are really, really active, like there's a lot of people that look for businesses full time, and they're looking at a lot of activity. So this is built to kind of help manage that activity.
Mm-hmm.
Yeah. But I'll show the deal structure calculator here. We can kind of play around with an offer. So this is where, actually this would have been fun, Keith, if we have one of your deals and we put in the numbers on one of your deals.
I can give you one off the top of my head if you want. Sure.
Okay, yeah, let's do it.
$2.3 million asking price.
Hold on, we're gonna name it. What's the industry?
We're gonna call it construction services.
Construction services. Okay. Oops. Construction. Oh my goodness, I can't spell today. Construction services. Okay. Purchase price?
2.3 million.
Okay.
I can't read that, so you have to read it out.
Oh, sorry. Normalized EBITDA.
560,000.
And is there an SDE on that one too?
No, just an EBITDA on that one. That's an investable one.
Let's just guess that it is 100,000. So
sure, make it 660. Yeah.
We'll make it 660. Any intel on the industry growth rate, or what this company is doing?
I would say probably just sort of 3.5. Just go with we'll just go with the consumer price index maybe. Okay. Corporate tax rate, it's a BC company, so 13.5. Or there's 13, I think. I should know
that. We'll budget 100 grand for the salary.
Yeah.
Okay.
Yeah. Well, Victoria's expensive. Victoria's expensive, so make it 120.
That's true. Very true.
And I'll just answer Glenn's question really quick. Glenn had a question about the BDC loan compared to other banks. We'll get into that discussion around different banks shortly.
Mm-hmm. Valid question. Maintenance, any predicted?
No, there's almost no CapEx on this one, so maybe put in like 10 grand.
10 grand. Okay, for anyone that doesn't know what CapEx is, Keith, do you want to explain that just in case someone's...
Yes, so basically most businesses have some type of capital expenditure required. So they've got stuff. They got forklifts, trucks, vacuum trucks. They've got excavators, whatever that is. To determine maintenance CapEx, you kind of look at the total value of the equipment new and then divide it by the number of useful years that are available to that piece of equipment. So for an easy example, an excavator that costs $300,000 to purchase and it lasts 10 years. you would have a maintenance CapEx of $300,000 in order to make sure that your company always had that excavator that it needed when it needed it. That. Did I get it right, Liz?
Right. I like it. Sounds good.
I
Simple.
love it. Yeah.
Okay, so right now we've got a purchase price of 2.3 and buyer's cash required is 2.3. Like that's a cash deal if I ever saw one.
I love it. Let's do it.
Let's do it. Well, we're going to start to plug in some loan info here. So lender amount. We're going to run this model. Like banks in Canada will kind of do 50 to 75% of the purchase price. So we're going to be somewhat cautious in this model, and we're going to say they're going to do 70%, which is about 1.6. Lender rate, we're seeing kind of in the range of prime +1 to 2.5. We're going to leave that. This is kind of on a lot of the deals we're seeing 7% in total on a lot of the most common deals we've seen, but Keith will say too, like it does, it can vary by industry. Some industries have a lower risk, and so it varies.
Yeah, it varies by a lot of things, it feels like to me. So like buyer experience is a huge factor in having a lower interest rate. So if you've got experience in construction services, your interest rate would be a lot lower than mine if I was to buy a business like this with no experience.
Mm-hmm. So you've noticed that because I put in the loan amount here, now my buyer's cash has dropped. So let's say that you've got a partner that's coming in for 100 grand and there it drops again. We're going to say, so we can incorporate any co-investors who are taking a different share class. So they may be taking preferred shares, which means they get paid out first before an owner or anyone who has a common shares position. And then we've got seller financing down here. So what we tend to see 10 to even 30% seller financing in some situations. Keith, what are you guys typically seeing?
Well, we like to see 0, but realistically, we try and prep our sellers for 10% from the outset. We don't really say we don't want to take them on, but we really work hard with our sellers to understand that they're going to have to participate in this in some fashion, whether that's a vendor note or an earnout or something. We prep them for 10%. And then, realistically, probably 10 to 20 is where it kind of lands most of the time.
Okay. We're gonna squeak this up. Like this is we're just playing around. So I'm gonna ask for 275, which leaves me with 315 that I have to come up with on my own for this deal. And I've got my one shareholder here who's kind of more of a partner, so they're going to come in with common shares with me. Okay, so we can run with this deal. We're not going to touch earnouts yet. We do have this box that this is just an acknowledgement. It doesn't happen in all deals. So principal repayment of seller financing assumed to begin after complete repayment of seller loan. This is just, it does happen in a lot of deals, but not all deals, where the bank has a requirement that the seller can't receive their principal payments until after the bank's loan is paid in full. So it doesn't happen in all cases, like I mentioned, but if we go up to our loan period here, this is the amortization period was a 5-year, and we're assuming this is a 5-year term loan as well in this scenario. So that would mean that the seller wouldn't get their 275 for 5 years, which is a big pill to swallow sometimes, but we put it here to make folks like yourself aware of it. Keith, what is your opinion of this arrangement?
Well, it only really comes into play is when the purchaser needs an equity injection that they don't have. So so I know we talk about this a little farther along in the slide deck, where we're talking about, what equity actually is. So there's 2 kinds of equity. There's the purchaser equity that Liz has sort of put into all those things, but banks will look at a 5-year interest only seller note or vendor note as equity in the deal. So so you're right, it is a big pill to swallow. And so unless you're prepared to sort of put up a chunk of real estate or a real asset, if you're looking for a big, $275,000 of unsecured debt, most sellers aren't going to take that at all, and their advisors will advise them strongly against that. So if you want that approach, you're going to have to sort of have some more skin in the game in terms of security on that loan. But yeah. So we try not to use any of this if we can, but the reality is we have to use it on almost every deal that we do.
Yeah, and Keith, being in the broker side of the seat, his goal is to get a fair price point and run a competitive process and bring the right buyer to the table. And ideally, it's a simple structure, but the market and that can happen when there's lots of buyers at the table and lots of flush buyers. But it doesn't happen in all cases. Some deals they're not as appealing to as many people as other companies on the market. So in this scenario, our buyer's capital is looking like, quick math here. I'm battling a head cold, so bear with me. It's over 10%, it's like 15%.
Michael has a question of how common are earnouts in the deals that we see.
I think we talked about this a little bit in the last webinar when we talked about business valuation. So earnouts are perspective and a seller's perspective. We hate them because they're hard to control. But we mostly see them when there's a valuation gap. So if I think the business is worth 2 million and you think it's worth 1.5, then we might construct an earnout that if the numbers, stay the same as 2024 or projected for 2025 or 2026, that the price gets paid in full using some type of an earnout structure. I would say realistically in the Main Street space, they're discussed a lot and enacted very seldom. So keep it simple and you'll get a deal done. If you start trying to make it, if it looks like you're trying to buy a, sort of a public firm with a public firm kind of a thing, those deals have a hard time sort of going through.
Yeah, we see them sometimes, but we don't it's not certainly the norm, I'd say. And certainly we see that deals don't start out with them. It's more in the case where, okay, we've gone through due diligence. We've, maybe there's some things that have come up, or for some reason the banks won't do, everything we wanted them to do. And, both parties are still committed and motivating to moving forward. How do we bridge this gap? We've also seen them when maybe historical, revenue factors were, doing this yo-yo thing. It wasn't, straight and steady, and there's a yo-yo for some reason. Or we see them when there's like a hockey stick growth, and for some reason, even though there's hockey stick growth, the seller is wanting out for one reason or another, or maybe it's in a high tech industry and they want some of the upside.
There's a follow-up to that. Sorry, is it common for earnouts to be based on future revenues or EBITDA?
I would say buyers really like EBITDA based on EBITDA. From our perspective as an agent for the seller, we would almost never do one based on EBITDA. It's manipulation is very, very easy, and it's really a recipe for future litigation. So we try and do them all on revenue. So if the sales are there as the new business owner, it's going to be up to you to drive profit. It's that's your job.
Yeah, I agree with Keith on that. Even being like buy side, the complication that arises from tying earnouts to EBITDA is also very challenging. And then the reporting that you're required to do, because you have to now report how you arrived at this, and they have a period of time to review how you arrived at your EBITDA calculation, and they're not in the driver's seat anymore. So it creates a lot of area for misalignments and disagreements, and that's where the lawyers say that a lot of the litigation will come from, is when that happens.
Yeah, we talk a lot about is the juice worth the squeeze, and I would say that for almost all sub $10 million deals, having an earnout based on EBITDA, the juice isn't going to be worth the squeeze for the time for paying for accountants, for paying for outside arbiters. It would be, yeah, you're just it's way easier just to look at your GST filings and go, okay, we're good, you owe us the money, or you don't, either way.
Yeah, we Village Wealth is hosting a webinar tomorrow on earnouts with Morgan Tate from Chinook, and we have a tax planner from MNP who's joining us as well. So if anyone wants to learn more about earnouts, you can join us tomorrow on a webinar and listen to Morgan.
Can you drop the link in there whenever somewhere that people can access where to register for that, Liz?
Yes, I'll have to wait till Keith's chatting away for a minute to go find it. But yes, I can put that in
the sharing again. Yeah.
Yeah, absolutely.
Oh, Sarah's going to help out. Thanks, Sarah.
Oh, perfect. Thanks, Sarah. I forgot you were here. Sarah is from our team. If anyone has had a call with Village Wealth, it's with Sarah. So she is also here. Yeah, well, I can keep, if there's no more questions, I can kind of get a rundown of the outputs here.
Yeah, I'd love to see them.
So it gives a really simple snapshot of where we're sitting on this deal now. So 4.1 time multiple of EBITDA, 3.5 times SDE, which are still fairly, standard for this size of business in these industries. So well done, Keith. You guys aren't reaching for something above market. So, which as buyers, we see a lot of out there in the market. So when we look to our debt to EBITDA year one, this is acceptable. Debt service coverage ratio year one, we mentioned they want to see over 1.25. If this was higher, it would be green and it would be, good or great. But it is showing acceptable right now. So that's a good sign.
I will say one thing in our defense, Liz, that we have $300,000 of working capital included in that price.
Oh, that would give me a check mark when I'm looking at this deal. I'm like, wow, they've been thoughtful, they've been considerate, they've pre-evaluated this working capital peg, because a lot of deals don't go to market with a working capital peg. So that's great. Thanks for including that, Keith.
If anybody wants to buy it, let me know. We'll hook you up.
This one's active on the market.
No, it's on the market, but it's under offer. So
you gave us one under offer. That's no fun.
Well, I think it's almost under offer.
Okay. Oh, now you jinxed yourself.
Exactly. I'm knocking wood like crazy.
Knock on all the wood.
Yeah.
Yeah, so this kind of just gives you a bit of a snapshot. So our teal line here is our normalized EBITDA for anyone who's looking on a small screen. Our yellow line is our debt servicing. And then what we'd love to see is the red line. The red line is our favorite line because that's cash after debt servicing. And so you can see debt go down, yellow line going down after the 5-year mark, red line going up. And then I'll show you the output here.
What's the blue line?
The blue line is interest payments. So it just broke out the interest and principal payments. Yeah.
Got it.
Yeah, and so this gives you a really simple way to grasp kind of, okay, will this, if I was looking at this company, will it work for me? Can I offer for it in this way? And it will quickly help people understand if it's something they want to move forward on, because we see a lot of people looking in the wrong direction or looking at deals for too long when they should, just move on because it might not work for them or not, but they usually don't find this out until, they've involved advisors or, paid some fees and gone down the road a little bit more. So, yeah, and then you can save different scenarios. So these are all the scenarios for this one deal. And so we can add new scenarios and keep the ones that we had before. So this is really helpful too. If Keith and I are in negotiations and this was my scenario 1 or whatnot, then I can always get back, or we've moved further on and I need scenario 5 and to go back and forth on what I've previously offered on. So,
yeah, this is fantastic. I knew you built this. This is the first time I've seen it though, so I think it's amazing. And to your point about looking at, sort of getting to this much later in the process, we've been spending a fair bit of time working with professional buyers in the last little while. And one of the things that we've learned from them is that they can get to know so quickly. So they're able to assess a deal very, very quickly and go, it's not going to work for me. I'm out. Appreciate it, guys. Then send me the next one and we'll take a look at it again. And from our perspective, and I think from the seller's perspective, and especially from the folks that are looking at multiple businesses right now, like focusing on the ones that are going to make sense for you is the key to success in this. If it's not kind of like a home run internally right away, then you should move to the next, because it's not for you, it'll be for somebody else.
Yeah. And that's like, and it's kind of like we talk about getting your reps in too. Like the more businesses that you look at and you review, the better you get at saying no. And you want to get to a place where you're saying no very quickly. This deal fit tracker is there to help folks with that as well. So this is just fun. It's just a tool that we put in kind of to help people just always remember your core criteria. So we can set ideal values. This is basically your search criteria. So if I'm looking for my earnings level to be between X and Y, I want a valuation multiple. Maybe I'm not willing to pay more than a 4-time multiple. Like I can change this and move it around. My seller financing, I'm certainly looking for a deal that has maybe a minimum 10% seller financing involved. Maybe I'm looking for staffing, management team. I'd like the manager would be ideal. And this is all customizable, so you can put in your ideal pieces, growth. I want to see a company 10% growth or higher and that sort of thing. Maybe facilities, and you can change all these features around, and they're saved on the left here. And then any deal that you're looking at. So this is the qualitative factors, the softer stuff that is very unique to you. These aren't going to be the same for everyone, and you can it scores it at the top. And then where we find this is really helpful is like if you're looking at dozens of deals at the same time, it can be really confusing to just keep everything organized. And when you find one that actually is the fit, it's going to jump off the screen at you. So this is just a kind of a fun thing we put together.
That's awesome. I like it. I like it a lot. Are we going to go back to share the other deck then, Brianne? Is that the plan? Yes, I agree with Michael. This tracker looks great. So,
thanks.
Can you see this full screen?
We can see your desktop as well.
Yeah, we see all your tabs.
I'm sorry that I'm so stumbly at this. I will get it better. There we go.
All good.
Okay.
Yeah, so we talked a little bit about the components of the purchase price as Liz was going through her tool. So basically, for most deals, the bank is looking for they'll finance 50 to 75% of the deal, and again, it's industry dependent for sure. So if you're looking in food services, the chances of more than 50% bank financing are pretty limited unless you're buying another franchise. If you already own a franchise in the same space, something like that, you'll be able to get better. But if you're just buying a random restaurant, getting 50%, even that's going to be hard from any bank. I mean, you probably won't be able to get that from anybody except for likely the BDC. So in terms of equity, so obviously if the bank's only good for 75%, then we need 25% from somewhere else. So equity is what you're putting in as a buyer. And there's a number of different components to equity. One that everybody's probably most comfortable with or knows the most about is purchaser cash. So you've got to bring some cash to the table, some skin in the game, as we say in the trade. And then there's other ways of getting equity into the deal. So vendor participation in terms of there's a couple of ways to go with vendor participation. One of them is for the vendor to keep equity in the business itself. We call that rolled equity. And sometimes that essentially you become a partner with the vendor. It is relatively unlikely in the standard one buyer, one seller sort of Main Street space, but it's very common in the private equity world. The second, and this is what Liz had talked about, and maybe she knows actually this part of it way better than I do, is using investor funds. So Liz, if you want to jump in there and to let people know how that could work.
Yeah, there's a variety of ways that you can raise capital for your acquisitions. One of the models is called a search fund. And so they will raise entirely for the equity portion, as well as a wage for themselves while they're searching. So as many of you know, it can be a year or more to find a business to buy. And if you want to do it full time, then you're lacking a salary. So search funds are a vehicle that were most more well known in the US, but they were finding their way in Canada. So that's a whole topic on its own. What we tend to see at Village Wealth is people using a combination of their own equity and then investor equity. So it could be family and friends that are coming in. It could be colleagues, or people are starting to lean to the angel investor community more. So you can raise capital from people who have a certain net worth. They're called accredited investors. And basically it just means that it's met a threshold of their personal net worth. So it could be their annual household income, or how much they have for like assets under management. So there is a definition that you can check, or folks that can check if they're an accredited investor. If they're not family and friends and you don't know them, they are supposed to be an accredited investor in order to be able to invest in your acquisition. But investor returns in this space are trending around the 25 to 30% return, which is quite attractive for a lot of investors that are looking to diversify, maybe away from real estate or other investment vehicles. So it is kind of an emerging asset class that more investors are starting to pay attention to. So it's certainly not one to be overlooked.
We have a couple questions. Are you guys okay to take them?
Sure.
Yeah.
Right, one in just relation to what you're talking about. I've heard of search funds. How do people actually find investors or firms that would be able to support them financially in this search fund situation?
Yeah, great question. We're not kind of in the search fund space, but there are a lot of people in search fund communities. So if you've ever been on, if I get it wrong, I know someone here is going to be able to correct me. Searchfunder.com.
Yeah. Search Funder is so active. I was just in there last night. There's tons of folks out there looking for money, and there's lots of people that are happy to fund. So and it's very deal dependent. I will say that for sure.
Yeah, but it's a great community for learning about search funds and meeting a ton of other people who are actively doing them. There are communities of search funds, and then there are investors. So they call him the grandfather of search funds in Canada. Mario Negro is a lawyer in Ontario that is kind of spearheading a lot of this activity in Toronto. Toronto is kind of like the hub of search funds in Canada. So definitely tap into that network of people, and people who are in that community are very generous to speak with other people who are exploring it. It's a very supportive community. If you're just starting out, just try and find other people who are in search funds now and talk to them.
Yeah, and there's a platform in the US, I don't know if it's available in Canada, that is basically sort of democratizing the process, and you can put your name in as somebody that's looking for a sponsor, and there's folks out there that are looking to invest in deals. So, and I wish I could remember the name of the software, but it's growing rapidly. So I'm sure if you do a quick Google search, you'll be able to find it.
It might be Mainshares. Is that Mainshares?
No, Mainshares is a little bit different, but it's like that. Yeah, or maybe I feel like it's not Mainshares, but I could be wrong.
Yeah, we find investors fall into two camps. There's like investors that will talk and engage pre-LOI, and they'll nurture the relationship and they'll support with their advice. And then there's investors that are like, nope, I don't want to talk to any searchers before they're under LOI. Once they're under LOI, then send me the term sheet, and I'll say yes or no. And it's like it's very quick.
So.
Yeah, it's a challenge in the broker. It's a challenge for the sellers when that's the approach that's being taken.
Yeah.
We like to see sort of verifiable funds before we go into an exclusive relationship with somebody. And if you're a searcher and you're not able to provide that, then we can probably still keep moving forward, but we're not going to go exclusive, I don't think, with something like that. And then it's a challenge to get investors if you're not exclusive. So it's chicken and egg thing. So I don't know. I don't know what the best answer to that is. It looks like we have another question. Do either of us help with capital raises? We don't. It's a specific license that allows you to do that, and I think it's I can't remember the name of the license. We have one of the folks here has it, but it's a lot of work. And it's again juice and squeeze for that, so we don't do it.
Yeah, we can help to a degree. So the license that Keith is mentioning is an exempt market dealer license. We have an exempt market dealer partner, so we can help to a degree with investor connections. But we have to follow a certain. It's a compliancy. It's with the Securities Commission. So we just as long as we're doing it in a certain way, then yes, we can help. Happy to have a chat with you, Michael.
We also, sorry guys, we missed one question. AC is asking that, if you're buying a business that has a smaller customer base with jobs are sort of project by project with like only a few key relationships that make up their revenues, as a buyer, how can you build in sort of security for future projects? Like, do you have,
Again, it's a good question, because that's exactly what the one that we were talking about is. I think on this one, it's likely to be some form of an earnout, and the earnout isn't going to be dependent so much on revenue, but probably on projects, on project acquisition. So yeah, you can structure it that way, and as long as they're sort of we're doing our jobs as brokers and deal managers, making our sellers aware that this is going to be perceived as a risky business, so you're going to have to be prepared to adjust your expectations in order to get a buyer to the table. So yeah, I would say most of the time, in very specific instances like this, we'll have to be more creative than normal.
Mm-hmm.
So the next thing that we're going to talk about is where do we get debt from? And so 50 to 75% of your deal is going to be debt. And where does the money come from? So we definitely have the financial partners and lenders, and they're pretty much sort of two specific groups here. One is the BDC, the Business Development Corporation. They're fantastic for smaller deals that are cash flow lending only, or they're cash flow lending smaller deals. We love the BDC. We do a ton of work with them. And then on the larger cash flow transactions or larger asset-based transactions, then the chartered banks will give you a better rate in terms. Liz, are you seeing the same sort of things?
Yeah, the chartered banks are better rate in terms than BDC, but BDC is like they have advantages. They can be flexible in the repayment schedule. They can flex if it's a seasonal business. They can be flexible. We see things like or not balloon payments, but principal holiday, where they give you like an interest only period, so they can be really flexible with you. So that's what we find, where more so with the other banks, that the other banks are kind of more like, here's where and when it starts and here's when it ends, and you pay us the whole way through. And BDC can be a little bit more flexible.
Yeah, I would say that the BDC, we like working with the BDC a lot. They are flexible, and they do have no trouble working with the other banks. So they see themselves as a partner to CIBC and RBC and BMO rather than a competitor. So, and because the BDC does sort of acquisition lending, and they don't have any sort of regular banking capabilities, they almost always partner with somebody. So that the partner might be CIBC or RBC or BMO, and that partner is going to be offering a line of credit of some description, probably credit cards, the regular commercial banking arrangements. And the beauty of that whole relationship and arrangement is 2 or 3 years into business ownership, and if you've got a BDC loan loan sort of at 13% or 12% or some high interest rate or 9 or 10%, very often the bank that you've been introduced to or working with the charter bank will come and go, yeah, you guys have been doing a fantastic job. You can see your bank account's growing, you're paying yourself, and we'd be more than happy to take out a BDC loan at a lower interest rate. So you basically refinance your debt somewhere along the way.
Yeah. I'll also throw in here, there's some smaller alternative funding sources that you can tap into depending on where you are. So Community Futures is rural, and they will do up to 150,000, I believe, for an acquisition. And then if you're under the age of 39, then there is Futurpreneur that they don't do as much. I think it's 75,000, but they can also cover closing costs, and you get 2 years of free mentorship with Futurpreneur. So there are some there, and there's women's programs in Alberta and BC that will also do some lending for women in acquisitions.
Glenn put in there, I know she did mention TD. Are they harder to deal with? That's why they're at the bottom of the list. No. Our experience with, well, actually, what I can talk a little bit about that. It's not so much the TD or anybody else. So I think a lot of times, especially in the smaller business side of the equation, when sort of sub $1 million kind of space, you'll typically a purchaser or a buyer will come in, go to their local branch or TD or BMO or whoever, and say, hey, I'm looking at buying a business. You guys can help me out. And the small business banker is like, yeah, we're here for you. We're going to be happy to help you out. And then not really understanding their own lending requirements. And it happens a fair bit. So unless you're dealing with sort of a commercial banker, you're going to kind of get smoke blown, I think, from the person that you're dealing with, that you've dealt with in the past on the small business side of things. Because fundamentally, the charter banks won't do cash flow lending on deals less than on sort of debt amounts less than $2 million. Is that about right, Liz? Is that what you're saying?
No, there are exceptions. Like, we have seen them come to the table on some of the smaller deals. It can depend on the industry. Like, if they have a good portfolio of companies already in one industry, they may come to the table on it. But like, for some of them, absolutely not. Like, National Bank tends to stay above the $2 million mark. Some of them have more of an appetite than another. This is a lot of what Village Wealth does, is we work with our members to take them to the right bank that fits for them in their region, in their size bracket. Like, to do the bank dance can be quite cumbersome. So I wouldn't say exclusively just go to BDC under 2 million, but you certainly do have less options if you're buying business under 2 million. I would certainly go to BDC, early on to understand what they can do as one of your first stops.
Yeah, I agree with that as well. And sort of a big shout out to Liz and then the debt broker folks that we work with. They talk to banks every single day, so they know who's doing what when. So if you're trying to find your own debt without the support of some type of a broker, you're likely going to end up paying more and being on worse terms and wasting and spending a whole bunch of time with folks that aren't going to give you the very best deals. Yeah, we've seen sort of fantastic outcomes when banks are forced to compete against each other. Very much like a mortgage broker. If you're looking to buy a house, you'll tend to get a better deal with a mortgage broker than you will if you just go into your local bank that you've been dealing with for a long time.
Yeah, and we find and there's the timing of it too. Like, once you get under LOI, like, you have kind of 60 to 90 days to complete the deal. And so everything's on hyperdrive at that point. But a lot of the banks won't really give you a yes or a yay or nay. Like, they don't do pre-approval in Canada. So you can't take a solid deal to a bank until you're under your letter of intent. And at that point, you're like, the clock is ticking, and you've got to do all your due diligence and your legal due diligence and the purchase agreement while you're trying to court multiple banks to see who's going to do your deal. So it's an intense, fun period of time.
Yeah, And as it sometimes happens, if your bank, declines at the last minute or at the semi-last minute, like your month into due diligence, and your bank, for whatever reason, decides that they're not going to go forward, then you got to find another bank right away, and then you start the process from ground zero. So going with somebody like Village Wealth that knows what the bank's requirements are, and a lot of times the bank's requirements are based on sort of what their own internal guidelines are. And so if the RBC might have a mandate that, we've got some extra cash and we're not weighted very heavily in small business acquisitions right now, and so we're going to do under $5 million loans at a great rate to try and push some money out, right? So Liz will know that. I won't know that, and the buyer won't know that. But because you have that inside edge, because you're talking to them every day, that you're going to get your clients the best rates and probably the best terms and the ability to close, which from a seller's perspective, the ability to close is the single biggest thing that you want to have at the table. Like, you got to be confident you're going to close.
Yeah, and we also know who to go to.
Sorry, Liz.
Sorry, Fran.
I know that Sarah mentioned there was quite a few people from our webinar that are going on to Village Wealth, and so I just wanted to mention that there is a discount code if you guys sign up, Chinook 100. That gets you $100 off if you guys sign up. I just want to mention this in case people are popping off early to get back to work. So yes, definitely keep this code and save yourself the money. And then do you guys want to sort of jump through these last few pages? We only have a couple minutes left. Or should we just leave them up so people can screenshot? How would you like to do this?
We can send the recording out to everybody, but I think if we don't show the pair, then we'll be really sad the rest of our lives. I spent a lot of time with an AI tool last night making sure I got that one right. Yeah. So a good thing to know is I think that we're going to do this really quickly, but basically, what are your risks when you take on debt to purchase a business? So what happens if your business goes pear-shaped? Obviously, sad. So you can do a couple of things. You can try and refinance the debt, or you can declare bankruptcy, or you can go into, start liquidating your personal assets to pay off your loan. Horrible things that will happen. But if we skip over to the next slide, let's talk about sort of the good news. The good news is that very few business acquisitions fail. We spent some time working with the BDC on this. The numbers that they've given us is they expect about a 4% failure rate in general. The last 5 years or so, it's been less than 2. So that's a 98% chance of success. So it is, everything's risky, but the risk return on a small business acquisition, I would say it's weighted more heavily in favor of success than the sort of the risk profile that people tend to think about warrants. That was my quick to get it done by 1 o'clock.
Thank you. And thank you to everybody that joined us. We have one more session next week on due diligence, the nitty gritty. So please join us for that one. It's next Thursday at 12 p.m. PST. And thanks again for joining us. I will have this webinar saved. So if you'd like the recording or to go through it, just let me know and I'll send it off to you. Okay.
Thanks, Fran. Thanks, Keith.
Nick,
thank you very much.
Thank you.
Bye, everybody.
Bye, everybody.